So Freya, we've got tension in my household at the moment because our friend Amanda gave us a box of After Eight mints. And you're thinking, why is After Eight mints? Other mint brands are available, obviously. Why is After Eight mints such a tense thing? And it's because my wife does the thing where she takes the chocolate mint out and the empty wrapper stays in the pack. So then when I go in, I pick it up and it's an empty wrapper. Oh, this is middle class marital tension. Completely. So my question is, what creates tension in your household?
Similar vibe, actually. It's the nice wine being used as cooking wine.
Hello and welcome to Agonomics with me, David Udall. No, it's not a hoax or deja vu. It really is that time of the week already. We're here to try and bridge the gap between economics and agriculture and help farmers understand how the economy and money matters affect their business. Good karma, happiness, call it what you want. It's got to be a good thing for both of us. In this episode, we'll be looking at the recently published Pork and Cereals and Oilseeds market outlooks. To do that, I'll need the help of a couple of expert guests. Thankfully, this week I'm joined by analysts Freya Shuttleworth and Millie Askew. No bad blood here. I reckon we're going to have the best day. If you think we're the one, please follow and subscribe to this podcast to make sure you don't miss an episode. New shows drop Wednesdays at midday, and please get in touch. Comment on any of AHDB's social channels or send us an email, agonomics@ahdb.org.uk. So what have we been doing at AHDB Economics World recently? Well, we've been monitoring the cattle price, which is continuing to go through the roof. We are now at, in the middle of February, it was about 635 pence per kilo, and this time last year we were just scraping under £5 per kilo. So it's a considerable increase. We're seeing really tight markets. It just comes down to the very basics of supply and demand. There's a really, really tight supply. Demand has still been strong, and therefore it is just needing to increase the price to pull those supplies out of the market. Obviously, this then feeds through to the retail market, so there's a point where it will all start to change and the demand profile will change. But for the moment, prices are just going up and up and up. And speaking of things that aren't going up, we released some analysis looking at baking trends recently. And interestingly, shockingly, home baking is in decline for both savoury and sweet baking. What is Paul Hollywood thinking? The decline comes as fewer people are baking, and those that are baking are doing it less frequently. However, sweet baking happens more than savoury baking. Where are those cheese scones? Everyone's going for the sweet scones, not the cheese scones. Scone, let's not start that. No. So if baking is in decline, then obviously we're going to be talking about cereals and oilseeds. There's my segue to get back on track with this. We're going to be talking about flour spend. Last year was 33.7 million, which has increased by 7% on the year before. However, consumption of flour has decreased by 11% since 2023 compared to 24. So obviously it's costing more, but we're buying less of it. Consumers are now looking for convenience, which is leading to less scratch cooking and therefore the reduced use of flour. It's also causing a loss of engagement in flour as well, because baking occasions are down as well. So it's interesting. I guess we can talk about this in terms of the impact on the wheat market and if there's a shift in the way that flour is being produced, but it definitely seems as if baking is happening less, which is shocking in this country, isn't it? You would have thought that baking was the cornerstone of what we do, but obviously not. So we're going to kick off this week by talking about pork, moving away from baking, moving to pigs, and we're joined by Freya Shuttleworth, our senior analyst for livestock, focuses on the pig side of things. So welcome, Freya. So we've released our annual kind of big picture market outlook, haven't we, in terms of the direction of travel for the next kind of year, 18 months or so. As we've done when we talked about the other sectors before, do you want to kick off by just giving us the headlines of what we're saying for the pork market?
Yeah, so on the production front, we're looking at a relatively flat to steady year in 2025 for production. So that's on top of the 4% increases that we saw in 2024. That's on the supply side. And then on the trade side, we think it will be a bit more volatile, mainly driven by current geopolitical tensions. So that will be an evolving feature as the year goes on. And then more on the kind of consumption and consumer demand side, we think retail volumes will be down, but less so than they have been in previous years. So we're looking at about 1%. However, there is some positivity on that market, as it does seem that the food service sector is still gaining strength.
So let's talk about the supply side then, Freya, in terms of what's going on with that, because there's a couple of interesting things within that. We have seen a reduction in the female breeding herd, haven't we, from the pork side? So is that something that's going to carry on in terms of having a longer term impact in terms of supplies?
In a short-term basis, we think that we'll see a little bit of, not necessarily recovery, that's definitely too strong a word, but we do think that numbers will come up a little bit in the next 12 months. We're forecasting about 1%, so they'll sit about 330,000 head come June 2025. Long-term, we think they'll probably steady out about that. We have forecasted out to 2026 to 2027, and we think that they might creep up to about 340,000 head. So that would be an extra 10,000 head over 3 years. But that would only put us in a position of having similar pig herd numbers to where we did in 2023. We'll probably reach a stability position, but that's not factoring in any disease risk that might happen, which would definitely negatively impact herd numbers.
And also something that's going to be not necessarily a risk, but something to monitor, comes back to performance. And we've seen an extended period, realistically, since the start of 23 of positive net margins per head in the pork sector. We saw quite a stark reduction in that to one of the lowest levels that we've seen for quite a while at the end of 24. So in terms of, I suppose, the margin view, is there any risk on that side that if margins continue to tighten that we might see a change around in terms of the forecast of supply?
Definitely. If margins contracted quite substantially, we would probably anticipate that some in industry would decide that it's no longer economically viable to be in the industry. We have seen that in the period 2020 to 2023. We were still losing producers, and most of that was for those negative net margins. Although margins had recovered slightly in 2023, they weren't filling the black holes that were already seen financially in some pig farming businesses. But 2024 has carried on that positive trend and seems to have brought a bit more stability and positivity to the industry, with people actually looking at investing and looking at those longer term trends. But definitely if those costs, certainly those key costs of feed, for example, or bedding or buildings and maintenance all crept up, then we would be having to review those numbers.
So that's the supply side. One thing that interests me about the pork sector is around the trade aspects. And I guess not just the pork sector, but all agricultural commodities at the moment, because we are seeing, increased level of volatility around the world because of, protectionist trade policies that are being put in. And I don't think that, there's any immediate risk to higher tariffs on pork products or etc. coming out of the UK, but it's that knock-on effect is the thing that's the risk. So what's the outlook for trade in the pork sector? Where have we been in 24, and where do we think we're going to head as we go through the rest of this year?
The 24 was actually a relatively positive year for trade. Although export volumes were pretty much flat on 2023, there were many challenges. So for the most part, UK product with our higher pig prices has been less competitive on global markets. So we have lost some market share in some markets such as China, for example. However, the majority of our pig meat exports are still made up of offal, and that is still a growing sector. So that is really important to our producers in terms of the carcass balance and therefore keeping the value of pig meat within those pigs when they get their dead weight pig price. So although it's not huge gains, it's definitely still a positive picture. And on the flip side, our imports in 2024 only increased 1%, which, considering that from August through to the end of the year, the EU pig price has been falling quite substantially and creating a widening gap between the UK and the EU, it's telling that there's clearly some demand on the domestic market for British pig meat, that we're not just supplementing volumes with cheaper imports. And likewise, we're not exporting huge amounts more, despite the fact that production was higher, which means that we must have a good domestic supply base and demand base. keeping us in fairly good balance.
You've segued nicely there, Freya, because you mentioned prices, and that was what I was just looking at, and I was just going to ask you about in terms of that difference between EU prices and where the UK stands. Because, we've mentioned previously that through 2024, really, in historical terms, we've seen a very steady period of pork prices. And it's obviously started to decline towards the latter half of the year, but that decline is nowhere near as stark as what we've seen from the European perspective. So just to put that into context, at sort of the midpoint of 24, we had our SPP price for domestic pork at about 210 pence a kilo, and the EU prices were trading in the sort of high 180s. So we were kind of a 25 pence discount from the European market to ours. Whereas now at the moment where we are when we get to the end of 24 moving into 25, we've seen our prices drop to about 205 pence a kilo, and EU prices down at 160 broadly. So you've kind of gone from a 25 pence a kilo discount to more of a sort of 45 pence per kilo discount, which is a significant change in a short period of time. And the domestic market's been tracking lower, but European market's had a significant dip. So, from a trade perspective, you would think there's going to be an impact, but it's also just interesting from a price perspective that we're seeing a sort of a muted follow, as it were, from a domestic perspective when that European market has been dropping so strongly.
Definitely. So historically, the UK and the EU have sat more closely aligned. There has been periods where they've drifted apart and then drifted closer together again. At the moment, the forecast for 2025 is probably that the UK price may drift slowly more towards that EU level. Certainly in the most recent weeks, the EU pig price level has started to level off a little bit. However, the SPP has had marginal decline week on week. We're not forecasting a drop off a cliff. We're just forecasting a little bit of gradual levelling up in the market. But likewise, prices will still be supported seasonally when those big demand peaks come in. So we often see some prices pick up just before the summer when we look ahead to barbecue season, and again towards the end of the year, looking ahead to Christmas, ensuring that we've got those supplies of those key products that everybody wants.
And coming back to what we were talking about a minute ago in terms of margins, as the domestic price sort of slowly erodes, it is technically putting the market at risk of lower margins. And the critical thing, as we've spoken about before, is the proportion of feed in cost of production, that is 60 to 70% at times in terms of the proportion of feed and grain and oilseeds that go into producing a pig. And that's going to be the interesting thing, and we'll talk about that in terms of the cereals outlook coming up. Obviously, as the pork price drops, it is putting it as more risk in terms of if we see upwards market volatility in the cereals price to then erode that margin, and if that has an impact on farmer decision making. Nothing that's an immediate issue, but I suppose it's one of those ones where we were in probably a more comfortable position 6-8 months ago than where we are now, and we're heading into that period as we go through the spring when you see more volatility in the cereal markets. So there could be some sort of, I would say, shorter term pressures potentially put on margins if we see an upward spike in grain prices, if there's any weather issues around the world. But we'll talk about cereal prices separately. So let's finish up with demand then, Freya, because we've always seen that competition in protein between pork and chicken predominantly. And in 24, we saw retail demand for pork fell by 2.4% year on year. And we're moving into a period where we've had lots of consumer pressures because of cost of living issues recently. Food inflation was one of the drivers that was quoted in terms of the recent increase in inflation that we saw back up to 3% that was reported earlier in February. And I think there's definitely more of an uncertain economic outlook that may be preying on consumers' minds again. So that cost pressure might come back into the decision-making view of consumers, especially when it comes to meat choices and protein choices. So what does that all add up to in terms of where we're standing for the pork outlook for 25 for consumption trends?
So overall on the pork market, we're probably looking at a 1% decline in volumes in 2025. So that's a lesser fall than we saw in 2024, but noted that there is very much still a downward trend, unfortunately. A lot of this, as you mentioned, is driven by retail volume, and it is driven by consumers feeling those cost pressures. So whilst the price difference between pork and poultry, primarily chicken, fluctuates, consumers will be seen to chop and change those product mixes depending on what price they deem most reasonable at the time of which they are purchasing. So that might mean that we see more switches to things such as chicken legs, wings and thighs out of either the pork sector, but also that would also see us lose some of those chicken breast sales as well into more economical cuts. On the pig meat side, though, it does mean that we would see we would expect to see that some gains in things like pork mince. So not only would that benefit from lower prices, it would also possibly see some gains from the beef sector, especially with the currently very high beef price. So we might see a bit more movement from the other red meat sector into pig meat if the prices stay lower. But as we mentioned earlier, food service is still meant to see some quite strong gains, although it's a much smaller area of the market, so it doesn't drive the overall total volume. With more people returning to the office, it does benefit things like food to go, and those things think of those savoury pastries like sausage rolls, but also actually ready-made sandwiches, so the classic being ham and cheese. All of those benefit the pork sector as well.
And we were saying earlier about baking being in decline and savoury baking being in decline. Homemade sausage rolls could be the way. Increase flour, use more products of flour, and then with the sausage meat, maybe that's what we should be doing is make your own sausage rolls. Anyway,
I think we've got our next marketing campaign.
Exactly. I'd be happy to. I'd front that up. I love a sausage roll. Anyway, we're getting on tangent, but off tangent within that. Freya, thank you for your review of the pork market. We're going to take a break now to get the latest from the markets. And when we come back for the second part of Agonomics, we're going to be talking about the cereals and oilseeds sector and see if we can further get in some food references.
Hi, I'm Freya Shuttleworth, Senior Analyst at AHDB, with a look at the UK pork market. Deadweight pig prices continue to ease as we progress through the second month of 2025. For the week ending 15th of February, the EU spec SPP stood at 202.8 pence per kilo, a decline of 3.5p since the start of the year. Lower pricing is being driven by improved supply, seasonally weaker demand, and the continued pressure of falling EU pig prices. The latest DEFRA data stated that UK clean pig throughput was up nearly 5% year-on-year in January 2025. The differential between the EU and UK Grade S reference price has grown further to over 50p. Despite the larger price differential through the latter part of 2024, full-year trade data shows that UK pig meat imports were up by just 1% year-on-year at 789,000 tonnes. However, export volumes were almost flat compared to 2023, standing at 298,000 tonnes. This is despite production growth of almost 4% in 2024. To find out more on what might be to come in 2025, read our Sector Agri-Market Outlooks, published this February. And for the latest data and analysis on red meat, dairy and arable markets, head to ahdb.org.uk and click on Markets and Prices.
Pork. British pork. Pork is sticky, pork is spicy, pork is air-fried, slow-cooked, baked. Pork is high in protein, low on cost. Pork is sauce around your chops. Pork is not just Sundays. Pork is midweek, every week. This is British pork, but not as you know it. Pork is...
Welcome back to Agonomics, and as you know all too well, this is where we begin again with another sector outlook looking at cereals and oilseeds. In the first part of the podcast, long story short, we were talking about pork, and we were talking about the market outlook there, about how we've got a big price differential between the EU, as well as some demand challenges because of consumer behaviour. And we mentioned earlier also about baking and how in-home baking was reducing, so we will talk about flour milling. But we are joined by our lead analyst for cereals and oilseeds, Millie Askew. Millie, I've got a question around 24 crop outlook, because we produced our early bird survey at the end of last year. And I think there's always been a bit of questioning around crop areas, given the weather that we've had in the last couple of planting windows. And there's some questions that potentially the wheat crop area could be slightly higher than that early bird survey was projecting.
Yeah, so if we cast our minds back, obviously, to last year, to the 2024 crop, we had an abysmal, really, autumn planting window, which led to a reduction in harvest area of wheat, and we had a much smaller wheat crop for the 2024 season. Fast forward to 2025 early bird survey, which we carry out in conjunction with the Anderson Centre. That survey was carried out in November. I think it's important to point out that it was an early point in November, because while there wasn't the major weather issues, we had the same as sort of autumn 2023 for the 2024 crop, we did see some regionalised very wet conditions in certain areas of the country, which we believe may have impacted the results of the early bird survey, which is actually a survey of planting intentions. So currently, the wheat area on the, or as the results from the November early bird survey, is projected to be 5% up on the year at 1.61 million hectares. However, speaking with people and speaking with agronomists and also farmer levy payers, actually we think that it could be slightly higher than the 5% up on the year, leading to a bigger harvested area for 2025 of wheat.
And obviously crop conditions is going to be the key thing going here. And it's always a pretty crappy time of year to try and judge a winter crop coming out of dormancy over the winter. Everything looks grey and dank and kind of muddy and is a technical agronomy term. But it's always tricky at this point, and you would hope that we get some improved spring weather, because we've had a couple of tricky years with obviously like crop conditions. But it does seem as if, whilst I guess it wasn't an ideal period, crop conditions are generally okay. There's always areas that can be improved, but we're not in a disastrous perspective from crop conditions at the moment.
No, and again, I think our last crop conditions report, which we released, was at the end of November. We've got one due out in March, but as at the end of November, 44% of the GB wheat crop was in good or excellent condition, with 9% rated as in poor or very poor. I think it's again important to note that was around the time prior to some of the very heavy rains we had in certain regions of the country and certain areas, but that again was somewhat localised, and since those results we've had 2 or 3 major storms, so it is a bit of, I say, suck it and see. But we the conditions weren't awful at that point, but they still weren't the best, and it would be just it's going to be interesting to see how crops have fared over somewhat of an adverse winter in some areas. And again, I think it's going to all hold off onto spring conditions. I think, going forward, looking at actually the amount of spring crops going in the ground, as well as the condition of the winter crops that are in the ground.
Yeah, and then if we kind of project that forward into production, if you use that early bird survey figure on average yields, you're getting a crop of around 12.5 million tonnes, aren't you? But actually, if you increase that early bird area slightly higher, you're pushing towards 13 million tonnes. So it's an improvement on that 11 of where we were, but we're still below historical averages, really.
We are still below historical averages, and I think that probably leading on to the demand side in a moment. I mentioned earlier, obviously, the smaller 2024 wheat crops that we had. However, with relatively subdued demand we have domestically for the 24-25 season, and the very lacklustre export campaign we've seen, we are likely to end this marketing year, so that's July this year, 2025, with quite hefty carry-out stocks above the 5-year average as such, and then rolling again into a larger crop year with no expectations of huge shifts in demand as it stands at the moment.
And another one of those reasons, like you mentioned exports there, but one of the reasons why we're seeing that sort of increase in stocks is because we've seen, again, historically in senses, very, very large imports of wheat for a prolonged period now as well.
Yes, so again, just as I throw some stats out there just to put it into context, from the start of the marketing year, so July 2024 up until December, so that's the half of the marketing year, we imported, or the UK imported, a record level of wheat, so for that period. I'd like to caveat that with the fact, though, that a large proportion of that is from the likes of Germany and Canada, where we can safely assume that is of that high spec, high protein milling quality wheat. And we are under the belief, from speaking with industry and trade, that imports will slow during the latter part of the season, the second half of the season particularly. We believe a bit of sort of front loading has gone on. So imports, with prices being favourable, or with currencies being favourable for imports, there's been quite a lot of front loading going on. So less imports are expected during that part. I think it's also, again, worthwhile pointing out that while this year's domestic crop is expected to be of lower quality, actually it's turning out to be more functional than first thought by millers. And we've heard that again from our sort of miller stakeholders.
Which is a good thing. So we were talking about bakery usage going down and how flour usage was declining. So if we've got a very functional wheat crop, that's kind of what we need. Then we can produce the flour, and all we need is some ingredients and some recipes, and people will bake again. Anyway, this isn't a baking show. But I suppose we did kind of mention demand there a couple of times, and obviously it will be interesting to see how that domestic demand profile shifts and changes as we move from what's been a tight season of supply and an expectation of tight domestic supplies through to something that is slightly more ample if the weather comes through. But as you said, it doesn't necessarily mean there's going to be any big structural changes to the demand side. It's more about import replacement.
Yeah, it is, I think, somewhat. And again, that is the sort of import replacement does again somewhat sit on, from a milling point of view, especially we're looking at that there, sit on a quality perspective. If we have another poorer quality crop, we will still see strong imports. I think my gut feeling is we won't see its imports as strong as it is this season with the large, if we have, again, caveat that with the larger crop. But there will always be a certain amount of import requirement from the milling side for that high quality milling, which we cannot physically grow in this country. So that is always going to be a requirement. I think from a demand perspective from flour millers as such, it's expected to go forward this season and into next season as somewhat lacklustre. Well, not really changing as such. It sort of trickles along at a steady line, if not very, very steady decline over the last 10 years, but there aren't any major changes. I think if we look at the other sectors, if we're sticking on the human industrial side, if we look at bioethanol, I think what's going on with the uncertainty around the Red 2 status for our UK feed wheat, there is a bit of uncertainty there in terms of what's driving demand. As on top of that, we are seeing at the moment really highly competitive, I say highly competitive, but very, very cheap US ethanol imports coming into the country. It's cheaper for us to import than it is to make. So we are seeing that coming in at the moment. So both of the UK bioethanol plants aren't expected to be running at full capacity for the whole of this season, at least, and going forward at this current moment in time. And it's also worthwhile pointing out the type of cereals used. Because again, earlier on in the season, maize was very cheap to import compared with domestic feed wheat and also importing wheat. So we're expecting maize usage in bioethanol to be a lot stronger this year, taking up market share again for its efficiency and again around this sort of Red 2 question mark.
Yeah, that's a whole big question. I mean, we've mentioned it a couple of times, but we that's a whole world that we can go into in a lot more detail. So I guess the question overall is, it seems as if there's, from a domestic perspective, we've got an expectation that there is a continued strong level of imports that are coming through, probably ones that have already been pre-booked when the market was more advantageous earlier in the season. If the weather holds, we will see a larger but not necessarily significant crop, but which does just mean a more sort of comfortable supply and demand balance. So we're not in a position where, from a wheat perspective, we're talking about abundant exports. We're probably in kind of like a comfortably balanced position, or not uncomfortable, if that's the way to put it, which then just leads us back to the global view, doesn't it? Because it kind of puts us in that slightly tricky position that we're not kind of, bouncing at the top of the market with import parity. We're not having to compete at the bottom of the market with export parity. There'll be kind of moments where it will flow in between. So realistically, we're very much just driven again, as always, by the global.
By what's going globally. And I think the market is somewhat, looking at the global markets as a whole, I think the market at the moment is very much underpinned by what's going on with maize. Maize, as we know, is the floor of the global grain market, or typically is the floor of the global grain market. And this season we're seeing some sort of questionable moves, but some moves in the maize market. We saw when all the wheat prices earlier last summer spiked, we saw maize tootling along because of high supply. We're now seeing, and it was very much at a discount, like I said earlier, hence why we imported so much maize. But now, going towards sort of, at the moment, maize prices are coming up and creeping up, and that is driven largely by what's going on in South America, particularly Argentina, and the very hot conditions. They've had the hot, dry conditions, which is expected to impact the crop over there. So we're seeing maize prices going where we've got global maize ending stocks expected to be at a 10-year low this year, which is quite phenomenal, really. And I think at the moment the market is somewhat desensitised by what happened in the world 3 years ago with the invasion of Ukraine by Russia. And actually what's going on with the sort of global stock situation isn't necessarily having an impact on markets as it necessarily would have had. Well, probably pre-5 years ago, pre-COVID. I think it is going to be really interesting to see what's going on. I think, again, rumbling on in the background is that Russia are expecting a smaller crop for 2025. I know that's very difficult to get information out of Russia, but I think underpinning also what's going on, sort of being a bit of a safety blanket for this sort of smaller global maize stocks, and also what's going on in Eastern Europe, is actually that Chinese demand isn't as buoyant as it once was. And I think that at the moment is acting as a very bearish factor on what is looking fundamentally like a bullish market.
I think it's one of those things where it's set up, as always, we're saying about like how crops look a bit kind of bland at this point in the year, but it is because we're building up to that period where everything starts to grow through the spring and early summer, and you go through those key marketing periods of kind of late April through May when you've got yield development but also planting of US corn and soybeans. It kind of feels, again, especially from a US perspective, that if there's a significant US maize issue, that could be the next big driver. If maize stocks are already a significant low, that's the next thing where you could go, that's where the potential fireworks will come, rather than European wheat issue. It could be a US maize issue that's actually the thing that creates those big moves up.
But I think, again, on that point, I think, so that's looking at the 24-25 season, which for us ends this summer, but actually looking at the 25-26 season, they're currently looking at the soybean and the maize ratio or price relationship ratio in the US is looking very favourable towards US farmers to plant more maize on land where they can plant maize and soybeans. Therefore, it's looking likely, again, this is not a dead cert, but farmers in the US tend to make these decisions around what they're going to plant, maize or soya. Maize is looking the most favourable crop at the moment, given the high prices. So we may see this sort of situation of tightening global maize situation actually in the 25-26 season to be more of an ample supply of global maize. Again, caveat that with what's going on in South America.
And that's why everyone's focus goes to that US maize market, doesn't it? What's the weather forecast for that, Illinois, Iowa, classic corn belt through mid-April onwards? That's going to be the thing. If it is chucking it down with rain and they're not planting, that maize market is going to be feeling quite tight and painful. But if they've got good weather and it's going in, that could be the point where actually we're talking about a global supply and demand situation longer term, which is, like you said, balanced, not significantly stressed. And from a UK perspective, if we're in a more comfortable position, it may not mean that prices are going to go through the floor and we're talking about significant drops. It's more just it's reducing that potential upwards volatility, and therefore marketing decisions essentially become more difficult because you're operating in a tighter window of price volatility.
Definitely. I do think, so bring it back to the UK, it's very much at the moment our supply and demand situation, or the demand situation, is somewhat lackluster. I know obviously you spoke with Freya earlier on the pork side, and pork feed or pig feed demand this season and going to next season is meant to be somewhat down on the year. Again, the other side of monogastrics, poultry feed demand, we're expecting to be a bit sluggish again based off current data, but there could be a switch up in demand on that side. So I think really for next year, the watch points are, again, the big uplifts or downfalls could be in the animal feed side.
Yeah. And like we were saying earlier, in terms of the pork perspective, with prices that were sort of slowly drifting lower and margins that have, again, reduced over the last 6 months or so, if there's a risk area for the pork industry, it's definitely around, again, the flip side of what's the benefit for the cereals farmer in terms of a problem with US maize plantings. That's going to be the painful thing for the pork farmer with their cost of production going up. So that's ultimately, I suppose, what the one key thing of this is, that's the crux of where potentially that short-term market volatility over the next 2-3 months could be driven by, is around that global feed grain complex becoming far tighter than it is now. Right, thank you, Millie. We'll call it there. That was a really interesting view. I mean, the critical thing there is linking how those two markets are together in terms of the cereal supply and demand affecting pork cost of production. That's the crucial link there, which is why we do them in the same episode, because it makes sense. Obviously, everything we've spoken about is on our website, so please do go there and look at the agri-market outlooks to get all of the information across all of the sectors. We've also got an economic outlook, as well as looking at farm inputs, so animal feed, fertiliser and straw, so please do go and look at all of them. And for the eagle-eared of you that was listening, you would have noticed that we'd put some Taylor Swift songs in. You may ask, why Taylor Swift? Is it because she's into agriculture? I don't know. Is it a cynical attempt for us to jump on a social bandwagon to get more people listening to the podcast? Who knows? We'll try and find out and see what happens. But maybe next week we'll see if we can get Taylor Swift on. I think she's probably got time.